So that's the money and what they're looking at. But how do we then value going forward? And I'd like to invite Hala Mata Chufeni into the fold and her panel to discuss that. Hala is the president of Middle East, Africa, and South Asia for HVS. So thank you for joining us, Hala.
Thank you, Matthew. And if you allow me, I'm going to continue with the theme of hard talk, because when we talk valuations and transaction, it is quite hard. We would hope to address today valuation recovery, transactions, if any, the incentives and defaults, and also to look at investment risks and rewards in the hotel sector, not just in Africa, but also the Middle East. So it is my pleasure to welcome to this panel the bankers, the lenders, those with the deep pockets. So please join me with welcoming Jamie from Standard Chartered, Luri from Westmont, and David from Casada. David, Olivier definitely did pick up some of the questions, so I can only expect much more will come. We have very limited time to address these important topics, so I have personally decided not to present, but provide you with a brief summary of the HVS Hotel Valuation Index 2021. It will be released online by the end of the month on the HVS online library, so please do check it out. I'm just going to share with you, to set the stage for our conversation, the key takeaways. So what we have done is we've considered approximately 1,000 properties across the 4- and 5-star market in those 20 cities. And although there was a limited number of hotel transactions over the 18 months, unless the panelists will disagree, the trading performance definitely of those hotels that remained open or reopened have performed much better, suggesting that we are seeing recovery. That is more relevant to the leisure properties when compared to the corporate properties. And despite the global pandemic that impacted clearly travel and tourism and the resultant values, I'm much more comfortable today reporting on values than I would have been back in 2020. 1 year of minimal income, and in some cases certain properties that have closed down, doesn't necessarily mean the value has disappeared. These are naturally, hotel investment are considered as long-term investment, and because they are based on the income potential, I think what is going to be tricky is the recovery and how long it will take the different markets to recover, and whether, and I think this is key, they will ever surpass the previous level of operation. So in value terms and numbers, just very briefly, we have seen an 18% decline in regional values. And when I say regional, that's the average of Middle East and Africa combined between 2019 and 2021. The worst hit hotel markets in Africa was Johannesburg, and in the Middle East was Mecca. The least impacted markets in Africa was Seychelles, clearly, but in the Middle East, it was Doha and Riyadh. Now, we do definitely forecast recovery over the next 3 to 4 years, perhaps conservative recovery, so we're looking at a compounded annual growth rate of 1% between 2019 and 2025, but 7% between 2021 and 2025. There has been a lot of discussion on RevPAR recovery. I'd probably say we are also looking at improved values on the account of EBITDA improvement. And in summary, just to basically highlight what has happened and how this is going to impact our conversation on value, I think what we have seen much more than ever, the importance of sensible development costs. And that is, again, one of the topics that we will address: income capitalization versus development cost valuation. The need to appoint an operator that delivers. There has been a lot of discussion around that, but more importantly, perhaps deliver on the GOP rather than just on RevPAR, and the importance of decreasing costs. So that's pretty much just setting the stage, and with that, I would kickstart with the gentleman. And first, with you, Jamie, especially any reaction to what I had shared, but more importantly, how did the bank deal? Were there any defaults? How did the bank deal with defaults? especially when considering that specifically in the UAE there was advice or recommendation from the government to support hotels.
Yeah, no, thanks, Hannah. So I think it's important to consider, and it's definitely a theme that I've heard so far today. As Standard Chartered, we look to support kind of the best-in-class assets and best-in-class sponsors. And I think that the belief in that strategy through the 2020 was really, really important. And I think that, the UAE government encouraged, rightly so, that the banks provide, short-term relief to clients in terms of, principal repayments and, certain covenant relief. And I think that, we worked within the framework that we were provided. And, while, there was definitely some very difficult negotiations, we found that because we were very comfortable with the sponsor and the operators, and even when the asset performance declined, we saw that the asset performance rebounded very quickly, and the operators were able to, within a very short period of time, return to, not necessarily pre-COVID performance, but, we've seen, within our client base in terms of, particularly on the ADR side, really, really strong recovery. And as a bank, we had certain monitoring in place to ensure that over the period of, the 12 months after we were approached to kind of have some amendments, that the clients were at least on a pathway back to recovery. And fortunately, within the clients that we've supported, that has now happened. So, and again, in terms of defaults, we didn't necessarily see any defaults, but I think it's also important to consider that, within Dubai, where we kind of focus, there is a fragmented market, and that, particularly your beachfront high-end hotels have done very well, whereas, some of the other hotels, which particularly rely on some of your business travel in particular, have seen some impact, and there's also been some supply pressure there as well. But I think from a banking perspective, we took the view to on our sponsors and the operators, and the belief that even if there is an impact which is longer than we expect, these assets are core to their strategy. They will support them where needed, and we have seen really strong support where it's been required. And the belief in that we've chosen the right sponsors and the right assets was really important, and that strategy proved correct. And now, hopefully, there's strong tailwinds in the market now,
right.
And hopefully there's going to be a recovery.
Yeah, especially with the recovery, and that what you just described is relevant to the entire Middle East, or specifically as we speak of the UAE.
Yeah, I think it could apply across the region. I think, as you said, we've seen a strong recovery here in Dubai, but you didn't even mention Dubai as the strongest market, well, the market that's been impacted the least. So we think, across the market there are a lot of keys coming into the market, but the keys that can tap into a client base that they understand what their client is after, they can attract them in the right way, and they're located appropriately, they are going to continue to perform.
Well, that's very encouraging, but I'm not sure if it is as encouraging to Luri and David, because clearly what I'm getting is that there were no defaults, some have struggled, but perhaps we don't necessarily have distressed assets or potentially distressed owners. So if I can travel a little bit to Africa and ask you, Luri, what's your perspective, similarly on defaults, but more importantly on opportunities, and when we assess specifically distressed opportunities?
Yeah, I think, we saw some of this in 2008, 2009. The rolling loan gathers no loss, right? This time around it's a little bit different if you look at Middle East and Africa, because you've got vast amount of government and kind of fiscal support helping out in the Middle East, supporting the banks through various channels in the central bank. The African countries generally don't have that, and where they've had that, they've exhausted the resources. So as it pertains to the transactional market and valuation specifically, we are seeing channels of distress opening up in Africa that we're not seeing in the Middle East, right? Whether those are through the lending side, whether those are through foreclosures and administration. or whether they are, people and hotel owners, specifically regional chains, that have learned their lessons in the last two cycles, past few crises, and they're looking forward and they're saying, look, I'm going to have a tough conversation with my banks in 12 months' time. I've put them on notice. They've put me on notice that this conversation is going to be a lot tougher than I would like it to be. So therefore, I need to start figuring out what's core, what's non-core, and maybe start looking to dispose of this. Some people, some owners are being caught behind the curve. Some people trying to get ahead of it. But I think, to Jamie's point, the quality operators are managing to sell off assets in the middle of a very, very sharp recession to generate liquidity and shore up their balance sheets. And that, on the buy side, obviously that presents opportunities.
Right, and just as a follow-up onto this one, clearly, Luri, you are in situations where you're wearing the buyer hat and then the seller's hat. Currently, your portfolio is roughly 7 properties, but mostly in Africa.
Mm-hmm.
However, your investment strategy is to also invest in the Middle East. So if we could touch a little bit on investment criteria as a group, but more importantly, why do you think you have been more successful in acquiring properties in Africa versus the Middle East?
We've only got 14 minutes.
And
David hasn't said a word yet. We can't let him off the
absolutely, you can't
right?
take away his time.
I think again, everybody acknowledges that the Middle Eastern market is relatively opaque, right? Which makes price discovery hard in an up market. It makes it virtually impossible in a down market, right? I think from Westmont's point of view, we need to show our LPs and our investors we create value every step of the way. So we need to buy well. We need to be able to turn around operationally, so add value during the whole period and sell well, right? If we can't show all 3 of these elements, we're probably not going to hit our return targets. Right. So looking at the Middle East right now, I think there's distress, but there's not enough distress yet for us to be able to get a toe in here at a reasonable level. And I also think, depending on where you are, Dubai is maybe an extreme example, but you still have a lot of supply here. It's not
right.
necessarily stopping. It's not tapering off to the point where you think that it's going to stop anytime soon. So from an operational point of view, it makes it very difficult to present a turnaround plan on an asset if you've got a lot of supply coming into the market.
Yeah, absolutely, and spot on. And this is what we've actually seen when we're looking at value recovery, because you would think that the Middle East market would be ahead
Yep.
when compared to Africa. The reality is the supply and the pipeline is what is putting pressure on the EBITDA levels, whereas in Africa it is yet to grow and recover at that same level. David, what's your perspective on what we had just discussed? And more importantly, as Casada, you're looking to invest specifically in Africa, and perhaps you have a different strategy in terms of investments. And as a follow-up, also just looking at the risks that are associated with branding the properties and being limited to certain brands. Is that a premium on the value?
So let's address the distress side of the market. I think for the audience to understand, what's happening in Africa right now is not necessarily a severe distress and default environment where banks are liquidating, right? I think similar to what Jamie was mentioning, banks are working with their owners and their clients in order to support their businesses. But there's reality, and then there's cash flow, and there's a lack of government support that you've seen in the Western world. Therefore, owners are looking for solutions, and we are solution providers. We come in and we find solutions, and we've been able to acquire a bunch of hotels in the past 10 months or so. We've acquired 10 hotels, so which is quite significant considering our little secondary market in hotels is in Africa. But the picture is not a picture of defaults and sales and distress. It's a picture of stress and newly arrived institutional buyers like ourselves providing for the first time in history of that sector solutions. I think that's one thing to look at. And to Jamie's point, all the banks are working with their clients, but if you're an investor and you acquire assets, banks are retreating from the market, right? So there's no new capital. This is an asset class, real estate, where for the majority of the time, in order to get to acceptable returns, you need leverage. And the banks have kind of disappeared, but new institutions have stepped in, like the IFC and some of the DFIs, which we've benefited from in terms of financing. So there's a market structure issue going on the financing side, and on the distress, it's a really kind of a slow-moving event. Now addressing your question on operator, which we are a bit of a hybrid model, right? So we have a lot of capital to deploy, but one of our partners, effectively a strategic partner, is an operator, Accor. We're independent from Accor. We're not a division of Accor. We make our own decisions. We're an investment committee as well. But that strategic partnership also, in all due respect, enables us to operate and act in a really fast way. There's 39 brands in the portfolio. The team knows all the brands, and we kind of have all the tools in our toolbox. And as an independent, regulated business as well, we have to deal with Accor, just like clients. We're clients of Accor, and we have fun battles with some of the developers, et cetera, at Accor, and it's a healthy tension that we maintain. So as far as we're concerned, we're efficient in the way we work. We don't necessarily have to do a beauty parade every time we do an acquisition. And we have the right checks and balances, including an LP, which is a sovereign wealth fund that we have to represent as well. So as far as we're concerned, it's working well now, and there's enough brands to kind of come up with something. So for us, it works, but we're also specialists in the sector, so we can put pressure. We're specialist owners. We can put pressure on the operator in a healthy way like anybody would.
So you're pretty much suggesting that very similar to Rory, where he can go to different brands depending what works best and maximize the value, that you do have all the brands, and then therefore you will pick the best brand that will maximize value. But that's really, that's a question actually to you, Jamie. When looking at valuation, how important is the brand that is attached to the property, and not just in terms of the brand attached, but whether it's a management contract, whether it's a franchise? How much does this play part in your assessment?
Yeah, no, I definitely think it's really important. I think that it's also really important that you can have a really good operator, but operating an asset in a market that they're maybe unfamiliar with, maybe they're so it's having an operator that's not only globally recognized, but also understands the market where they operate, and also understand the nature of the guest, whether it's predominantly business or tourist, is it a local market, international market. So it definitely is really important that we have a really strong agreement that is in place, and depending on the situation, whether we can. There are levers within that agreement as lenders that we can put in place if we're if the asset isn't necessarily performing as we would like. But the fundamental thing is this operator the right operator to operate this asset in the market, and are they able to deliver, and can we buy into their business plan? Because we're not deploying equity like Quesada, but we have to believe in the business plan in order to put our balance sheet down onto the asset. Because we don't want to get into a distressed situation. We don't want to be in a situation where we have to enforce, we have to make the bad decisions. We want to deploy balance sheet, get our updates regularly, and be happy, right? And just it's really important to believe in the management team and the asset.
Okay, I just want to take a slight turn here and really look at the valuation approach, because oftentimes we're talking about values. What so far is clear, there were very limited transactions. Clearly, with the exception of Quesada's acquisition in Africa, and perhaps more recently the Maidan JBR property, there were no transactions. And the key question here is it because of the disconnect, which I mentioned earlier on, between development costs, expectations, buyer and seller? Is it the cap rates? And oftentimes this is what we as financial advisors are actually, and it's the time of the year, so I'm going to come under a lot of fire, as you can imagine. But I want to have a discussion around this disconnect between sellers and buyers, as well as the approach, income generating, once you've built it, this is at best. You spoke, Lori, earlier on investing only in those opportunities where you can add value, right? And then the cap rates, in the absence of transactions, what cap rates can we refer to? I mean, there is clearly a mathematical way to go about it, but I want to start with you, Lori. If we can talk about these valuation approaches as well as cap rate and the impact on the investments that you're doing.
Yeah, look, I mean, it's fundamental, right? And to your point, the lack of comparable transactions, this is not unique to the Middle East or Africa. I mean, that's an emerging market play, and Kingdom days, we had a lot of issues in Asia with this, right? So you don't have the comps to look at. You've got the mathematical approach to building up a cap rate that, you know, all of the kind of MBAs and finance students will be able to tell you. Then you've got replacement cost, right? Or you've got to look for something else and replacement cost. And so you know, let's talk through this. Ultimately, because these markets, there's just not the volume. You can't derive any useful information out of it. I mean, every time there's a valuation report from anybody in Middle East and Africa, the comp set stretches back 12 years, right? Because that's
right.
all the transactions that have been done. Fair enough. You know, the mathematical approach to building up cap rates, I can tell you from having sold a number of hotels that we've proven that does not work. We sold a number of hotels in a number of emerging markets inside the sovereign risk, the sovereign bond yield of the countries where we sold. So finance theory goes out the window, right? And then in a lot of cases, when you're really struggling for data points, what we have used, and we've spent money on this, and I'm sure this is not unique, is we do look at replacement cost, look at development cost, and you have to triangulate, right? You have to triangulate between the limited data that you have in terms of transactions, your kind of market view on where cap rate should be in that range, and then what does this look like from a replacement cost? And within these three, there's always, and I'm sure, David, you guys are the same, there's an awful lot of conversation around this, right? It's never one right answer, and it's a very iterative approach. But that iteration on iteration, there's a lot of value in that in terms of getting to grips with the transaction.
And David, would you agree with that? What are your views?
It's a very nerdy topic, but I love this topic.
And we only have 2 minutes left.
Yeah,
Can we get an extension?
You have cap rates in Africa, which when you go back historically, the market probably is not behaving in an efficient or rational manner. And the reason for that is the nature of certain buyers and the nature of the sector, where individuals or people were buying hotels at rates that sometimes didn't really make sense. But to make a long story short, as institutional investors are coming into the market, that efficiency and that pricing is going to get better over the next 5 years, and you'll see that. And hopefully, Lori and his platform and our platform will be impactful on that. So what's fascinating about investing in frontier markets is that you kind of have very advanced models, but you also have to go with feel, right? And the divide between buyers and sellers in Africa, for me, is based on 3 behavioral science reasons, right? One is home bias. People have a natural thinking that what's near them is more valuable. That's one, which is researched and analyzed and known in the world. And second is what I call founder's bias. I build this thing, this hotel, and it's worth enormous because it's the best. That's number 2. And number 3 is probably what Lori can expect and what we might have is the buyer's perception, the seller's perception of the buyer.
Right.
We have capital, therefore we might be an inflationary force into asset prices, even though we would rather step back than buying it. So if you put all these 3 combined, it creates a divide between buyer and seller that is pretty damn hard to close.
Yeah.
But that's our business and that's all we do. And especially in the context of Africa with culture and negotiation, it makes our job quite exciting. But
Yeah.
it's but difficult at the same time.
No, absolutely spot on. Again, I mean, as an advisor, I only pass an opinion of value, but that's what we also have these long discussions, that it's not enough to have a willing seller. It's how the buyer is going to run numbers and how much they will be prepared to invest. We have 30 seconds, but I still wanted to check if there were any questions that we haven't covered. Well, clearly I haven't covered everything, but I want to conclude with one question, and let's keep the answers brief. What is your outlook on recovery and the transaction markets? Are we likely to see more transactions? Jamie?
Yeah. I think just in the nature of Dubai, I think asset sales is going to be difficult, but I do, in terms of the lending perspective, I think there is a lot of liquidity for the right sponsors, and the lending transactions will continue and go on. But I still think that, particularly within the UAE, the number of transactions will structurally be limited moving forward.
Luri?
I think, yes, we are going to see more transactions, right? Absolutely. And the transactions will be correlated to how fast these jurisdictions recover. And it's going to be just an absolute patchwork quilt of recoveries and transactions coming up. And if you can move quickly and you understand your market, you will be able to do transactions. And I think the same goes then for your question on recovery, right? You're going to have multiple recoveries all happening at the same time, slightly different speeds, and that's going to create opportunity.
In our market in Sub-Saharan Africa, the next 24 months will be the most active in the secondary market in the history of that sector. That's my statement. It's going to be very active, and there's going to be a consolidation in the sector. Yep.
So we're closing on a very positive note. Thank you, gentlemen. This has been really insightful. Thank you very much. Thank you.